You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, listeners, no rest for the wicked. Right back at it with episode 2 of our doubleheader of OBC. Stay tuned after this, of course, for effectively a triple header as we dive on into the futures rundown with yet another Dan the Man Graham. So stay tuned for that if you're intrigued by all things futures. My name, of course, Mark Longo from theoptionsinsider.com. And, of course, where do you get access to all these live streams, the pro Q&As, options oddities, the exclusive content, all sorts of goodies. Theoptionsinsider.com/pro is the place to go as we go around the horn, see who's joining us today on the old OBC. Surprise, surprise. He makes the streak once again, none other than Mr. Dan P., a.k.a. Passarelli from Market Taker Mentoring. Mr. P., welcome back to OBC, sir.
Well, Mark, you know me. There's nothing I like more than streaking, so I'm back.
It goes hand in hand with the day drinking, I find. It's kind of, once you do one, you end up doing the other. It's the nature of the beast, listeners, as we keep on rolling into a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where you folks take the reins, your questions, your comments, your insights, your pearls of wisdom. We also pay off some of our questions of the week that we have been asking you. And Dan, our question from last week and this week are related, so I'm going to kind of do them together here. Let's start off with what we were asking you last week. Obviously, very timely. A lot of people were concerned about the escalation of the Middle East conflict. If past was prologue, most of these conflicts, you fade the early vol pop and you end up doing all right. So we asked you at the beginning of last week when it seemed like the vol was already starting to come off from that conflict. We said, hey, is this it or is this just the calm before the storm? Quite simply, will this conflict still be impacting VIX and the markets 1 month from now? So obviously 1 month from last Monday. And our audience, Dan, they went back and forth. They ended up coming down slightly on the side of yes, 55.3% saying this will still be impacting the markets 1 month from now, 44.7% saying no. So obviously it was a hotly contested thing, Dan. Fast forward to this weekend, of course, and we struck Iran. That got a lot of people more concerned about this conflict potentially escalating. And so coming into this week, we said, hey, last week, just slightly more than half of you said this impact is going to last a month or longer. Does this event over the weekend, does the U.S. getting involved in this conflict, does that change your view on the vol impact of this clash? Yes, Dan, is going to be more vol impact. Yes, it does change it. It's going to be less vol impact. No change, or you're just buying crude oil. Of course, since then, we have seen this what is apparently, hopefully, a ceasefire in the Middle East. So the game continually changes, Dan, as it does whenever these geopolitical events happen. But Dan, what do you think our audience is saying now? Are they saying, yes, it's going to be more of a vol impact as a result of the U.S. intervention this weekend, less of a vol impact, no change, or they're just going hard on crude oil?
I think that they're going to say less of an impact. Yeah, I think they're going to say less of an impact, which is what I now say also. I think if I remember correctly, I kind of forget, but if I remember correctly, I think last week I said it was going to stay up there or something like that. So yeah, less of an impact is my answer. Yes.
Yeah, it seems like our audience initially, Dan, thought it was going to be more of an impact. And then, of course, the surprise ceasefire seems to have moved people in your direction now. So actually right now, Dan, we are tied exactly a third saying, yes, there's going to be less vol impact. And also there's going to be no change to their outlook, which is kind of surprising. So they're still kind of where they were last week, which is interesting. 28.6%, Dan, say, yes, there will be more vol impact right now, which is kind of interesting. And then 4.8% say just buy crude, which so far, Dan, ain't working out that great.
Yeah, no, it's really not. But, you know, I mean, I think Iran dumped a crap ton of oil on the market going into this stuff. So that's probably, you know, I imagine all that'll balance out in a couple of weeks, I think. I'm not an oil expert, but
you play one on TV, sir. But you know what you are an expert in, Dan? It's your MTM question of the week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, Mr. P, what you got for us this week, sir?
Okay, so what indicators do I use when analyzing an option trade? And so it depends, of course, on what specific trade I'm doing, but one of the ones that I use, I would say the most, is the relative strength index. I really, really like that one. And I use it maybe differently than some people. I use it mostly for overbought and oversold scenarios, as well as divergences, to give, you know, just another little screen for any sort of directional indication, which is, of course, just one part of any analysis for option trading, the technical part.
Speaking of screens, Dan, you were talking before, one of your lost terms was screen traders. And some of our chat pointed out, most of us are now even just mobile traders and not even screen traders anymore. They're just on their phones. So that, imagine, I mean, we used to joke when we first, not even when we first started this network, just about, I would say 5 or 10 years ago, you know, that, oh, maybe we'll get to the point someday where you could run a hedge fund from the beach, you know, on your phone and a tablet maybe. And lo and behold, we're pretty much there now, Dan. Connectivity notwithstanding, as long as you can get connected, you have the tools to be able to do such a thing. So yeah, I guess we're all even just mobile traders now, Dan.
Yeah, well, maybe 5 years from now when we're talking to our AI hologram that accompanies us everywhere. Remember when we used to trade on phones 5 years ago? That was weird.
We'll all have either the VR headset or whatever the equivalent is. It'll have hopefully be shrunken down maybe to the size of glasses. So we'll all be walking around with our glasses, with our AI companion that's hitting bids and lifting offers all the time for us while we're walking around and executing our rogue algos on our behalf, and then Texas hedging them, Dan. See, that's a callback. Callback to last week's episode, listeners. If you didn't listen last week, you have no idea what the heck we're talking about out here. All right. Let's keep going, Dan. Let's get to some of the folks' cues. If you folks in the live have some cues, feel free to hit us up as well. Let's go out to Niels George. Niels George has a question about the risk premium. He said, I loved the lost term discussion on last week's show. Well, thank you, Niels. He says, can you guys clarify what exactly is meant by the term risk premium and how exactly do I harvest it? Yeah, I think that was one of my forgotten terms, Dan, from the episode 1, which is going back a ways now. Episode 1 of the lost terms saga, Dan. The lost terms odyssey. No, it's been a fun run here. But yeah, that was episode 1 of that. And we were talking about, Niels, the notion that, of course, that stemmed from our discussion of implied versus realized or historical volatility. The realized or historical volatility being effectively backward-looking volatility, what the underlying has exhibited over a period of time that you could look at, you could quantify, you can graph. It's real. And then the implied volatility is obviously just that. It's implied. It's what the market's best guess of future volatility is. It's the level of vol that is effectively implied by the pricing model with that option's price. When you look at the price of an option and you pull out all of the other Greeks, you pull out the intrinsic value, you pull out everything else, there is a level of volatility that is implied by that price. And so that's what that means out there. And obviously, when you're looking at a future best guess of vol, there's going to be a lot of wiggle room baked in there. So 9 times out of 10, 99 times out of 100, that implied vol level is going to be higher than the actual level of vol that the underlying exhibits, because it has to. That's kind of the way the options market has to work. So a lot of old school options traders and even a lot of modern options traders, they say, you know what? We know that implied is overpriced 99 times out of 100. Why would I ever buy it? Why would I not just sell options? And there is very much a school of thought that still adheres to that. And that is what's known as harvesting the risk premium. The risk premium is just the difference between that implied best guess in the marketplace and the actual level of vol that is being exhibited by that asset right now. That is the risk premium. If you want to harvest that, that means you're looking to sell that implied vol and hopefully buy it back at a much lower level down the road. So that's really all that means, and that's how you go about harvesting that. Dan, anything you want to add on the risk premium front?
Yeah, I mean, short answer is, how exactly do I harvest it? Sell options. Now, most of the time you will be taking advantage of that, but to be fair, not all the time. I am a big fan of trust but verify, knowing that usually options are indeed overpriced. If, gun to your head, you got to buy or sell. But if the gun's not to your head, you should do the analysis and see if, is right now the usual situation where options are overpriced, or is this an anomaly where they're actually underpriced and I would be making a mistake if I sell? So I like to kind of fine tune that.
And also, obviously, if you're going to harvest that risk premium, just make sure the juice is worth the squeeze out there. We were talking about this on the crypto rundown earlier this week about how Bitcoin vol is starting to get fairly anemic. So if you're out there just harvesting the risk premium in Bitcoin, make sure you're getting paid for the risk you're taking on out there. If your asset has a lower level of vol, then be judicious when harvesting out there. All right, let's keep going. Let's go out to, I like this handle, Dan, Big Bets with a Z. He says, when in a trader's education do you feel it's appropriate to make the leap from single month strategies to calendars? Still looking to make the transition myself. Well, that's actually a great question, Big Bets. And it's something we've discussed on this show in the past. Dan, I often refer to calendars and time spreads as the options 201 or even the 301. They're the leap, as he points out, a lot of people are reticent to take. They come into the game, they want to buy premium, they want to buy calls, they want to buy puts, they start graduating towards debit spreads. Maybe eventually they start selling some options because they learn about that. They learn about harvesting the risk premium, and they learn about all these other cool things. But very few of them are willing to make that leap to the 201 to the 301 because we've said it before, there's a psychological barrier, Dan. People like to be in that same vertical expiration silo. It's just easier. It's easy to look at it and be like, hey, I want to buy this strike. I want to sell that strike. If I'm between here, I make money. If I'm outside of it, I don't. It all goes away at the same time. But Dan, I know you do a lot of calendars, especially around earnings time. So that's a big focus of you folks over there at MTM. So you're doing a lot of this. What do you think in terms of education? When is the appropriate time to make that leap?
Yeah, so I call credit spreads and calendars the mother strategies, the mother spreads of option trading, because basically just about everything is made up of them, diagonals, whatever. And one is 2 different strikes, one's 2 different expirations. With the credit spreads, yeah, okay, two different strikes. Look at the P&L diagram. I stay on this side of the line. I win. I got negative Vega, positive theta. Boom, easy. But with calendars, it kind of looks like they're easy, but they are really a lot more nuanced, because you look at the P&L diagram and it's really just an estimate, because there's two expirations. What is the at expiration thing? Well, you can only look at the first expiration, and you don't know what the IV is of the second one at that time. So the break evens are just estimates. You're long Vega, but most of the time you want volatility to go down, but just in the front expiration, and you're really trading them like two different options. So they're definitely more nuanced. So yeah, this is a great question, Big Bets. I would say the time that it is appropriate might be now if you're asking that question. But that doesn't mean, oh, okay, well, Passarelli said I should start trading these today. Okay, let's go full in. Start real slow, start real small, and learn the nuances and learn while you trade, read some stuff on it or get some classes or whatever on it or something. I'm not really a big fan of waiting. Like, my first trade was as a professional trader. So I think the sooner you get to it, the faster it moves you to the finish line.
First trades. That's funny. I'll have to think about that. I think mine was a one lot of Microsoft calls that I bought when I was just not even a trader yet. And it was a super home run, Dan. It was like the most you could make on it. It was ridiculous. And I was like, oh, I'm a genius at this. This is so easy. Printing money. Kind of like probably some of the YOLO kids coming in today and throwing down a one lot on whatever ASTS or some other weird name, and they quadruple their money in a few hours. Like, I'm a genius. And then it becomes infectious, Dan, and maybe infective too, but infectious out there. All right, interesting stuff. Maybe we'll do a show on first trades, Dan. That'll be kind of fun. All right, let's go to this one here from 35 to life. So hopefully you're not in jail doing 35 to life there. Listen, I like the handle though. They want to know, I recently had a covered call called away on the Thursday before expiration. So 1 day to go, sounds like. It was still about 50 cents out of the money, and there were no dividends or news on the stock in the next 24 hours. I'm not really mad. I'm just wondering what gives. Well, yeah, you shouldn't be mad, right? That's a scenario where you win. If your stock is 50 cents out of the money, and someone says, you know what, I will do you the gift of buying it for you at a 50 cents better price, you should be pretty happy with that. Unless there were tax reasons, maybe you weren't planning on letting that underlying go, or maybe there were some other offsetting position reasons that you didn't want, in which case I could suppose maybe that would be a bit of an unwelcome surprise. Then you should be closing that out ahead of time then, if that's the case. You shouldn't be leaving yourself open to this. Because, yeah, in the last 24 hours of an options life, weird things can happen. People have to close out things for risk purposes. You didn't say which specific underlying you were talking about here or when this took place, so we could go look at it for you. Again, more details are your friends, listeners, when you have questions like this. But yeah, in the last 24 hours, you know the reasons. The dividend is going to be your first, culprit in this. It sounds like there were no dividends. Also, it sounds like there was no news, no developments on the stock in the after hours that would support someone wanting to do this. So you're right. It sounds like you just got lucky, Dan. And then sometimes this happens. And that's why if this was an unwelcome surprise to you for whatever reason, maybe tax reasons, it's another reminder that you can close this stuff out ahead of time if you don't want this to happen to you, Dan, right?
Yeah. So, it's interesting that there were no dividends. So if on expiration Friday, 24 hours later, if the stock was still below the strike price, geez, man, that's great. Another reason why this might happen sometimes is if the stock is hard to borrow. Now 50 cents though, that's still a lot out of the money. But I mean, if the stock is hard to borrow, a lot of times the market makers who have to hedge and arbitrageurs who have to hedge all the time and have to short stocks sometimes, they would be very, very excited to exercise those calls to get the long stock so that so that when they have to sell, they don't have to short it. They're selling the long stock that they own. So that could be a thing if it was hard to borrow, which you can ask your broker if it was. But yeah, man, if the stock still ended up below the strike at expiration, even if it was hard to borrow, great. I mean, perfect. Like chalk that up as a lucky little win. It's not a huge one or anything, but a lucky little win.
Take your wins where you can get them. Who asked that? That was 35 to life, and hopefully that makes you feel better when you're serving your 35 to life sentence. 50 cents comes in handy. All right. Come up against it here. Let's squeeze in a few more. Let's go out to, then I got to get to Dan Cubed on the day here. Let's go out to, got so many to choose from here. Let's go in order. Let's go to Davy Jones. Or just Dave Jones. I added the Y. Dave Jones. He says, I'm working most of my orders at the midpoint of the bid-ask spread, but it doesn't seem like I'm getting filled there very often. I'd say less than 20% of the time. Am I doing something wrong? Well, I'd say first off, 20%. Again, you don't give us any specifics. You don't say what kind of underlyings you're talking about. So that's going to obviously be the biggest determining factor. What underlying are we talking about? What's the liquidity profile like? That's going to dictate how wide the spreads are. If you're trading some name that's trade by appointment, does 20 contracts a day, then you should be thanking your lucky stars you get anything off near the midpoint, because that's usually you got to hit bids and lift offers to get anything done. And even then, you probably have to go through them to get any kind of size done. So yeah, again, specificity is your friend. But if you're trading an illiquid name, then 20% is actually doing really good. If you're trading SPYs or, at the money, NVIDIA, Apple, Tesla, that sort of thing, then you could probably reasonably expect, I should say, to do better than that in terms of midpoint execution, because they're very liquid. And market makers, as we were talking about last week, in these auctions and things, will be willing to step up because it's a very liquid name, and so they'll get you done at better prices. But again, love to know what underlyings you're looking at. But Dan, Dave wants to know, he's mad he's only getting filled at the midpoint 20% of the time. Dan, what are your thoughts?
Yeah, Dave, so think about it this way. Who are you trading with? You're trading with a market maker. They're the ones who make the bids and the asks. And usually any one given market maker is probably on both sides, on the bid and the offer. And they're running a business. They're there to make money, not to do favors. And the way they do it is they take what their models say is the fair value, and then they bid below it and offer above it. And that's literally how they make their money. And they take on a bunch of risk at the same time. So for you to trade mid-market, you're trading at exactly fair value. You're basically doing business with someone and not paying them. It's like going into the car dealer and actually knowing what they pay for the car, because, they lie to you and jerk you around and say, oh yeah, well, this is our sticker price, but we're going to give it to you below our sticker price. This is how much we paid for it. But the middle of the market really is pretty much the fair value. So if you're getting it 20% of the time, you're doing pretty darn good. But, there's a lot of nuance to this as well, because sometimes, I have had people tell me, oh yeah, I get filled mid-market on every single trade.
Those people are called liars, Dan.
Yeah, right. But either A, they're just consciously lying, or B, like they put it in like it's 2-bid it's 4-bid at 6. They put it in at 5.
Yeah, the market moves 2 handles and then they get filled, but it was the midpoint when I put it in.
Right. So it sounds like, Dave, you're being smart about it and actually realizing what it is. But yeah, like the bid-ask spread is your biggest cost typically, and it's because you've got to pay the liquidity providers. And that is reasonable. They're not standing down there to do us all favors. They're standing down there to make money. And so, yeah, making a deal to only pay them 80% of the time is pretty good.
They're not here to do you favors. They're doing me favors all the time, Dan. I don't know. You're just working with the wrong guys, Dan. You gotta change your market maker spectrum. Well, that music, unfortunately, means we're out of time for episode 2. We can't keep Dan the Man waiting for the futures rundown coming up in a little bit. If you're listening live, just stay tuned. If you're listening after the fact, then by all means, yet another reason you should be checking out the Pro. Lots of fun going on there. But before we go, Mr. Dan, if folks want to check out what you got cooking in MTM land, where should they go? What should they do?
Yes, sir. Come on over to markettaker.com, 2 T's in a row, and just go to the top right of the screen, then click on Join Free, and that'll give you more access to us. You can message me, ask questions, inquire about one-on-one coaching, get some free classes, lots and lots of resources there for you.
Lots of resources, Dan. Markettaker.com. Don't forget the second T for Theta over there, markettaker.com. That's going to do it for us on OBC. Back again instantaneously with the futures rundown, then back with our usual array of content throughout the rest of the week. We'll be traveling next week, so no live OBC, which is why you've already heard it right now. But, of course, if you're listening on the on-demand side, we'll see you back here next week, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.